morning. Welcome to IG's early morning call. It's the final day of May, Wednesday 31st. Let's take a look at the headlines as we wake up to what could well be a negative start across the European markets today. Some of it's been exacerbated by some poor economic data out overnight. Chinese factory activity shrinking. APAC indices on the way down. Japan's also on the way down because of some poor retail sales and industrial production data coming through. And regional currencies down against the US dollar. US dollar doing well on some fears that there might yet be some sort of last-minute failure of these negotiations and agreements around the debt ceiling. That still to come today. Late last night, HP shares falling almost 6%. The company missed revenue numbers and shipments dropped. PCs hitting HP's bottom line. And Russia seems to be pumping oil at will, upsetting some of the other OPEC Plus members. As a result of this, WTI and Brent falling below significant levels on the markets. Take a look at volatility. We're up today, back up over 20. 20 is always an interesting line in the sand to watch out for. It's a little bit arbitrary, nice big round number. Anything over 20 means there's a little bit more activity for us traders in the markets. You can get a bite on markets that are either up or down. And we'll see in the next 15 minutes some of the big moves that we've got as a result of where we are in terms of volatility. I want to begin with London's FTSE 100. One of the interesting markets, because we're now down back below the 200-day moving average. First time we've been down on this direction since the 15th of March. It's not too long ago, but you can see it has been a fairly good supporting line since it went down, last September, with that big dip down to the quasi-quartang lows, we call it that, when that budget happened, you'll remember. But in fact, interest rates are rising now at levels that we've not seen since that point in the market. So maybe there is potentially more downside to go on the London markets. Certainly London has been one of these markets that's been holding up. That red dotted line at the top of the page was the record high that we saw back on the 16th of Feb at 80.44. 74.83 is where we're trading at the moment. If you're short on this, your stop goes above the 200-day moving average, with a view potentially to pocketing some more profits as we go out from this point in time. It's not just London that's down. It's a general move lower across the world. The German DAX down at 15,803. Same sort of price action. If you're short on this, stop goes above some of the recent price action we've seen. But you can see we're a long way from the 200-day moving average on the German DAX, and indeed a lot closer to the red line, which is, say, that record high that we've seen, which were just peaking above the highs that we saw back in January last year. French CAC 40, same sort of cut that we've got at the moment in the markets, third day in a row of losses, and we're now down at levels there not seen since the 29th of March this year. So losses across the European markets, and it's the same sort of story across the markets that we've seen overnight in the Asia-Pacific region. Let's take a look at the numbers there. Nikkei down 1.65%. Hang Seng Stock Index down 2.9%. S&P ASX 200, the Australian benchmark, also on the way down. I'll take a look in some more detail in some charts in just a moment on this, but broadly speaking, we've seen some not particularly good economic data out overnight. Wall Street, let's just remind ourselves as to what happened there last night on Wall Street. The Dow Industrials ended down on the session overall, but we did see the Nasdaq rise on the trading day yesterday. We saw Nvidia becoming the ninth stock ever to top $1 trillion market value. And then Goldman Sachs came out and said, hang on a minute, no time to party. It's preparing another round of layoffs. Let's look at the Nasdaq and to show you what's been happening there with that punch high. Look at that shape of that candle yesterday. That was a shooting star candle, if there ever was one. And then the markets came all the way back down, the 24-hour markets, to close where they started out. And today we've got a red candle there. I want to show you the chart of Nvidia because this, as I said, yesterday was a stock that went to become, and indeed stayed up above the level at which it was a $1 trillion company, the ninth company ever to hit $1 trillion. And this story is now well-trodden. It's a well-trodden path. We've been talking a lot about that big rise we saw last week on earnings. Since then, the company's been cementing its position as the world's leading AI news story generator. And it's benefiting from the artificial intelligence interest in this particular area. That's really highlighted this move that we've seen. 197% up from the lows that we had at the beginning of the year. And that is one whacking great big news story as we've seen that company continue to add weight, a tremendous amount of weight, all the way up from those lows that we had around about $140, almost $400 a share now for Nvidia. And in yesterday's session at the very top of the market, it was almost $420 a share. So Nvidia adding an awful lot of extra weight. I was reading a paper from Rick Bensignor. He's a very well-known Wall Street strategist. He was saying yesterday he can't see any logical reason why you should be buying the stock of Nvidia at these levels. But you know what? You can't get in the way of a trend. And if you are continuing to be long on this, we saw a large upside candle wick yesterday, which indicates to me that there's a lot of concern about the really toppy end of this market here. So there might be an opportunity here to sell this down today. If you are long on this, all sessions on the IG platform, it starts at 9 o'clock this morning. You want to tie your stop in really, really close, a guaranteed stop really, really close underneath price action at the moment, because you don't want to get caught the wrong side of a trade if it does start to drop. And then you really want to take part in the downside. If you're a day trader, keep that stop in really tight up against your trade. If you're short, stop goes above where you want to start the trade. And if you're long, obviously your stop goes very tight in underneath to try and get some sort of benefit from that. Talking about some of the individual stocks, yesterday's stock stories. Just want to quickly touch on the Goldman Sachs story. It was down in yesterday's session. As I said, the company announcing yesterday afternoon it's preparing another round of layoffs. I won't go into details about that, but it's the same sort of story that we've got. Concerns about the economy. I think that people aren't really pricing in so much of the downside, which is, I think, still to come, because we've seen this concern about in today's trade. It's all about what's happening with that final vote on the debt ceiling talks. There may well have been an agreement between the Republicans and the Democrats, but it now goes down to the GOP to make that final vote. And there's some concerns about the fact that it looks like some people might be holding out for their position on this to try and get a better deal. It's almost too late to do that. We'll have to see what happens this time tomorrow. Will we be talking about a U.S. economy in debt default? That could well be the issue. I was talking there a little bit about what's happening with the Dow yesterday on the way down. Today down for a second day in a row. Not quite hitting this rising line of support. But if we do get a break of that, you'll also get a break of the 200-day moving average, which is something that I've just been talking about in the context of what's happening here in London on the markets there at the moment. Now, China factory activity in May has fallen to a 5-month low. Now, this is one of the reasons why we saw losses across the markets overnight in the Asia-Pacific region on this Wednesday's trade. The NBS manufacturing PMI contracting faster than expected to 48.8 from 49.2 the previous month and below forecasts of an increase to 49.4. Service sector activity remaining in expansion, that is above 50, but it came in at 54.5, its slowest pace in 4 months. Now, this is yet another indication that the recovery in China has been uneven at best, the world's second largest economy. Last month, imports contracted sharply, PPI fell, industrial profits plunged, industrial production missed forecast, and that list goes on of massive disappointments for these markets. Now, let's take a look at what's happening on the equity markets. I want to show you, first of all, the Hang Seng stock index. You can see on the way down in reaction to this, and that's now at levels they're not seen since the 29th of November last year, and we're well now down into bear market, 20.9% from those highs that we had. They're back on the 27th of January. One of the other areas of the world where we're seeing losses as a result of this in Australia, down below the 200-day moving average for the ASX 200 at 70.89. On the way now down, I suspect, possibly to these areas down here. If you wanted to put a fib on there to work out precisely where the next line of support would be on the way down, that would be your 61.8% at 70.50 as a line of support, and then at 69.65 if you're looking for downside price targets to work out for if you're short on these markets. Doesn't stop there either, because we've seen some downside for some of the regional currencies in today's trade. We've got a new recent low print for the Aussie against the US dollar. When anything like this happens negative in China, it does affect the Australian economy because of the relative close economic ties. We're now at levels not seen since the 10th of November for the Australian dollar, on the way down today at 64.92. The other regional currencies also suffering. This is the New Zealand dollar, lower against the US dollar at 60.15. As we see that trading there at levels not seen since the 10th of November. And let's take a look at what's happening with the Chinese currency itself. This is the offshore yuan. We're rising there. This is the US dollar rising against the Chinese yuan at 71.102. And that there, as you can see, it's at levels not seen since the 30th of November last year. So the US dollar is up against all those currencies, I think partly in response to that negative data out in China today. Doesn't stop there either, because we got some negative data coming through from Japan as well, which has had a negative impact on what's been going on there in some of the recent and local news headlines. Weaker than anticipated statistics overnight weighing on its equity market. Retail sales in Japan rising by 5%, in fact, in April from this time last year, but it missed economic forecasts for 7% gain. Industrial output, though, unexpectedly fell 0.4% in April from the previous month. The contraction dashing economists' median market forecast for 1.5% gain. Both domestic and overseas orders contributed to that drop. The production of chip-making equipment was particularly affected, down 24.6%, and falling demand from those wanting smartphones and vehicle equipment affecting flat panel making equipment, down 66.6%. I want to show you what's been going on some of these other markets for the region, because we've seen losses on the Nikkei 225 for a third day in a row, away from recent highs. You'll remember we were talking about this 39-year highs, I think it was, for the Nikkei at one point just a few days ago. So third day in a row of some relatively hefty losses there at the moment. And of course, what's been going on with the Japanese yen. This is the US dollar down against the yen. So the yen is stronger in today's trade. The yen acts in a strange sort of converse way sometimes when you get data out like this, because of its special qualities as a currency which acts as a carry trade. So the yen is slightly higher in today's session at 139.42, one of the few areas where the dollar is not at recent highs. Let's move on, take a look at what else is happening, because in a short while we get some breaking news headlines coming through in France. We've got GDP and CPI data out in a matter of 3 or 4 minutes' time. And at 1 o'clock this afternoon, German consumer prices out, which I think could well be more interesting data. The market's expecting index to slow to 6.5% in May year on year, a 13-month low from 7.2% in the month of April. Just wanted to swing past what's going on with the euro-dollar trade. Significantly, in the last few days, it's dipped below this line of support at 107.38, which is a 61.8% retracement. I was talking about this the other day, and I felt that when we got that candle closed below that, which was Thursday last week, that's your next line of support at 106.53. I think potentially there's a possibility of further downside to go. As I said just a week or so ago, the interesting factor about all this is partly to do with what's going on with that debt ceiling negotiation. And of course, people going into the US dollar as a haven, which is a little bit extraordinary when you consider that if there is a default, which is not the base case, then no one wants to touch dollars. But anyway, you've got the 106.53 line of support at 76 retracement, 76% retracement, which is the line of support down below where we are, which should be your price target. If you get a candle close below there, you then take your losses on all the way down to the 105.16, which is the total retracement, which would be around about the 200-day moving average. Canadian stats out today. First quarter GDP expectations, quarter on quarter 0.4%, annualized 2.5%. That's another reason to look at the currency markets today from the Canadian point of view. And US data out, JOLTS, job openings, and beige book numbers out later on this afternoon. 3 o'clock this afternoon for JOLTS, 7 p.m. this evening for the Fed's beige book. Now, let's move on to take a look at what else is happening in some other areas of the world. Corporate-wise, here in the UK, we've seen a couple of releases I think it's worth mentioning this morning. The first is WH Smith, the high street and travel agent retailer, forecasting a higher full-year profit. It's betting on a strong travel demand during the summer period. Total group revenue for the 13-week period ending the 27th of May was up 23% year on year. In terms of some of the detail, travel UK total revenue up a whopping 24%, so it's just proof that we're using stations, rail stations more, airports more, and these places where WH Smith has a lot of these small stalls. High street revenue up 2%, North American revenue up 26%. Look at the price action we've seen on Smith's recently. Apart from the fact we did see a little bit of a rise yesterday, we've seen some relatively hefty declines away from this 21.5% upside that we've seen since the middle of March. That bull market for WH Smith coming to an abrupt end. I think these numbers look pretty good. I think if you do believe this story that people are going to be travelling more this summer, which certainly seems to be the anecdotal. Um, uh, we're getting anecdotal evidence coming through from some of the big travel companies. As far as they're concerned, they're not making much money because the margins are so slim, but it does do some brisk business for WH Smith. I want to stay on the chart because I want to bring up another chart in the retail sector. This is B&M, European Retail. It's a FTSE 250 listed company. It'll open at 472 this morning. This discount retailer is forecasting higher 2024 core earnings. And why shouldn't it? It's benefiting from us that are finding the going tough and trying to find out areas of the market where we can get some good value deals. Group reporting adjusted core profit down 7.4% from last year, but like-for-like sales for its UK unit in the first 9 weeks of the new financial year were up 8.3%, which I think goes some way to explain the recent turnaround in sentiment from some consumers wanting to find some areas of interest. If you're long on this at 472, the stock goes underneath here at around about the 450 level, and your price target will be the top of this band here at 503. Now, here's a stock we don't talk about very often, Frontline. It operates a fleet of around about 70 tankers, which takes oil around the world, transporting crude and refined products around the globe. Frontline has just reported an adjusted earnings of 90 cents per share, beating estimates of 82 cents the same quarter last year. The group posted a loss of 1 cent a share. Revenue rising to 497 million compared to the 104 million this time last year. Now, like other shipping firms, Frontline pays a high dividend. This quarter, it'll pay a dividend of 70 cents per share. I want to quickly take a look at what's been happening with the Frontline shares. It will open at 166.34, third day in a row of gains in yesterday's session. This looks like a positive stock story to me. The stock in New York has risen by 42% margin over the past 12 months, 23% year to date. We know that because there's been a lot of pressure on supply ships, that these ships are doing well, and we've got that evidence out this morning from Frontline. HP, the former Hewlett Packard, fell in extended trade on the IG platform late last night after the company reported its fiscal second quarter numbers after missing revenue expectations. Let's take a look at the figures. Q2 coming in at $12.9 billion. Analysts were expecting $13.1 billion. The group's personal systems division, that's desktops and laptops, plummeted 29% in the period, while the company's printing segment recorded a 5% fall. Now, HP is not the only group in this sector going through difficult times. Global PC shipments generally declined nearly 30% in the first 3 months of the year. We're now at levels that are lower than before the pandemic. However, HP expects consumer demand to be stronger in the second half of this year. Let's take a look at the shares in HP. As I said, trading all sessions on the IG platform, and it was down sharply yesterday, ending down 5.79%. Now, after posting a better than forecast EPS of 80 cents in fiscal Q2, HP now expects an annualized adjusted profit of between $3.30 and $3.50 per share. Meanwhile, Hewlett Packard Enterprise posted earnings of 52 cents a share, 3 cents higher than forecast. Revenue missing expectations. That's not an all sessions stock. Now let's move on to another interesting area of the markets, and this involves Russia breaking an agreement with OPEC Plus. Certainly, that's how the markets are reading what's going on with the price of oil. I want to show you what's been going on first of all with WTI, US crude, down heavily in yesterday's session. There is word from the industry that Russia, obviously, as we know, desperate to find some sort of revenue stream income, is busting the sanctions that have been imposed on it by the recent OPEC Plus agreement. Now, the understanding is in the market that this is upsetting Saudi Arabia. Saudi Arabia's break-even is far higher than Russia, and Russia can sustain a far lower price of oil than we have at the moment. So it's quite happy pumping, quite happy, I say that in very loose terms. It's obviously wanting the income because of the amount of money it's spending on its war in Ukraine. And at the same time, the OPEC Plus group is getting very frustrated because it's seeing oil pushed down because of this extra supply coming on the market. So at the moment, at least, Russia doesn't seem to care how much extra oil there is around. And this is a story, I think, that potentially has further downside to go. Currently trading 69 43 a barrel on WTI, same sort of price action on Brent. Your price target, if you're short on those, is 63.76, which was the low we had back on the 3rd of May, which, to be frank with you, is a target which potentially could well be easily beaten if Russia continues to pile oil into the market. Now, OPEC Plus was set up to bring Russia into OPEC, the OPEC negotiations. It's not an official OPEC member, but what it does is it brings Russia in. And I think the original thought amongst OPEC nations was it was keeping your enemies inside the tent, if you like, rather than have them cause problems outside. And the issue is with this is the fact that Russia is, as I said, able to sustain a far lower price than Saudi Arabia. And Saudi Arabia's difficulty is finding profit at these levels on the market. Let's stay on the chart. Just want to quickly round off with a couple of other areas of the market. Fourth day in a row of gains at the moment for the price of gold. 1963 is where we are at the moment on the price of gold. Just wanted to touch on what's happening in the base metals market with one of the benchmarks, copper, sustaining at recent local highs, 81.30. But I think more of the interesting markets is what's going on with some of these agri-chemicals, agri-products, I beg your pardon. I want to quickly kick in with some of these interesting charts to watch out for. Look at this. This is Chicago wheat on track to post its 5th straight month of declines. There's a lot of extra supply expected to come onto the market. We're now at levels not seen since December 2020 for Chicago wheat. Soybeans, same sort of story, where we got big, hefty declines in the market. And you can see there, we're very close to breaking levels there not seen since the 15th of November 2021. When we get past that line of support at 184, you're then at levels then not seen since the 15th of December. All these markets are worth looking at potentially for a short trade. If you're short on these, stock goes above recent price action. And New York orange juice, we were covering this just a couple of days ago, up at these record highs. In the last 3 or 4 days, it's dropped, currently down 27,288. The problem is there, having recorded 6 months of gains in a row, which is how we're looking to close out the month of May. Obviously, a little bit of money taken off the table. But at the moment, at least, with restricted supply coming on the market this year, I think potentially there's possibly some more upside to go there for that. Look, we're running very close up to the point at which the European markets are expected to open, 8 minutes away. We're looking for losses across the board. Do watch out for WH Smith, which might buck the trend, as indeed we could well see potential upside as well from B&M at the start of today's trade. But they're relatively small stocks compared to the main market, which is down on concerns about the US debt ceiling. Will it get through that final hurdle later on today? Could we be talking about a US default this time tomorrow morning in the early morning call? We're back at 10:30 with Charting the Markets. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.